I knew a lot about him. I mean, I studied him very carefully, but there's a lot to be learned from both what Singleton did in his operating years and then what happened subsequently.
Warren Buffett called Henry Singleton the CEO with the best operating and capital deployment record in the history of American business. Henry Singleton founded Teledyne in 1960 and had a compound annual return of 20.4% over 3 decades. That meant if you gave him $1 when he first started the company, you'd receive $150 by the time he retired. In comparison, the S&P 500 would only have returned you $15. That's a 10x outperformance. That's even better than Warren Buffett, Jack Welch, and almost any other American CEO in history. By the end of this video, you'll learn 17 lessons from over 30 years of investing from one of the best capital allocators ever. Lesson number 1. Use overvalued equity wisely. In the 1960s, investors loved conglomerates like Teledyne. That meant their stock traded at 20 to 50 times earnings. Most CEOs in this instance would have felt proud of what they had achieved. But Singleton saw something else. He saw a trade. If investors paid 25 times earnings for Teledyne stock, he could use that to buy companies that traded at 10 to 12 times earnings. That gave him an instant 2x markup on the acquisitions that he did, and he moved fast to take advantage of this. By 1969, he had bought 130 companies using this method. Lesson number 2. Diversified at the holdco, focused at the portco. Those 130 companies spanned aerospace, insurance, consumer products, electronics, and specialty metal. When people asked him, why so many different industries? Singleton responded, the main reason is survival. If you stay in one lane, you won't survive. Everything has its day. But the thing that's important to note here is that every business had its own focus. They had to be excellent at one thing. A metals division didn't dabble in electronics for safety. It focused entirely on metal. It was the parent company's portfolio that provided the safety net, allowing the individual businesses to focus and specialize. Lesson number 3. Give freedom, demand result. Running 130 plus businesses required a different approach, and Singleton did it with fewer than 50 people at the HQ. His co-founder, George Roberts, explained how it worked. They manage you by the numbers. As long as you're performing, you never hear from them. But if you come up short, it's painful. Division managers had almost complete freedom over operations, hiring, and spending. But financial results were reviewed every single month. You either delivered your budget or you didn't. This hands-off style attracted entrepreneurs who wanted responsibility, and it filtered out those who wanted someone to blame. Roberts later described it a different way. You've got the keys to your kingdom. Just deliver the results and no one will bother you. Lesson number 4. Build metrics that people can't game. When you give managers that much freedom, you need to have the right incentive. But standard accounting measures had problems. Net income includes depreciation, which is an estimate of how fast equipment wears down. But depreciation is just a guess. If equipment lasts longer than you estimate, then the net income overestimates the amount of cash that the business generates. Cash flow measures the real money that's coming in, but a manager can choose cash flow by not buying new equipment. So the cash can pile up and the business looks good, but all of the equipment is in dire need of replacement. So Singleton invented the Teledyne return, which is basically an average of net income and cash flow. And this was a way to get managers to keep both of these numbers healthy. Lesson number 5. Profits first, growth second. Many companies chase revenue growth hoping margins will improve later. But Singleton did the opposite. His co-founder Roberts explained, we create an attitude of high margins. In our system, a company can grow fast and a manager can get rich off that growth, if the margins are healthy. If the margins are low, it's hard to get capital from Henry and me. Basically, managers who wanted money to grow had to actually prove that they were profitable first, before Henry and Roberts, his co-founder, actually gave them money to invest. Lesson number 6. Make every dollar compete. By 1968, the conglomerate boom was cooling. Teledyne stock had fallen from 50 times earnings to about 10 to 12 times earnings. It was still decent, but it wasn't easy money for acquisitions anymore. So Singleton immediately stopped buying companies. He explained his logic to analysts. Using stock at 12 times earnings to buy a stock at 15 times earnings actually hurts the returns to your shareholders. But he discovered that he could buy his own shares back, but buying his shares back at 8 times earnings gave him a better return than he could find anywhere else. So what did he do? He shifted his entire strategy to entirely buybacks for 14 years. Lesson number 7. Strike while the iron is hot. In 1972, Singleton offered to buy back 1 million Teledyne shares at roughly $20 per share. Shareholders actually surprised him and offered him 8.9 million shares, which was almost 9 times more than he was expecting. Rather than turn away these extra shares, he actually bought every single one. When asked why, he explained, we figured it was a fluke and couldn't do it again. But instead of going up, our stock went down. So we kept tendering, the first at $14 and then doing 2 bonds for stock swaps. Every time the tender was over, the stock would go down and we'd tender again, and we'd get a flood of new shares. The important thing to note here is that he didn't let this stock price falling hurt his ego. He recognized it for the opportunity that it was. Lower prices just meant that his purchases, his tender offers, became better deals. Over 8 tender offers across 12 years, he ended up buying over 90% of outstanding shares of Teledyne stock. Those buybacks alone returned 42% per year. Lesson number 8, think from first principles. Singleton had 3 degrees from MIT. When he first announced the buyback, analysts were very confused. At the time, they weren't part of the standard CEO playbook. Some even accused him of financial manipulation. His engineering background allowed him to think from first principles without being tied down by convention. To him, the math was simple. Buy $100 of earnings for $66, that gives him a 15% return with minimal risk. Lesson number 9, there's an art in finding usual assets and using them in an unusual way. Buybacks weren't Singleton's only unusual move. Insurance companies collect premiums today, but only pay out claims months or years into the future. During that time, the money is sitting in a place that's called a float. It's not the insurer's money because it eventually goes out of the door as claims. But in the meantime, while the insurers have this money, they can invest it. At the time, the industry convention was to invest this float in bonds, which was pretty conservative. So when Singleton went out to buy some insurance companies, the sellers priced them as if this conservative return would continue. A company with $100 million in float that was invested in bonds with a 6% return was valued based on that 6% return. But when Singleton took control, he took all of that float and invested it in stocks, especially during the beaten down markets of the 1970s. This was riskier, but it gave him a lot higher upside. In essence, he basically paid for a bond portfolio, but ended up running an equity fund. As a result, he was able to capture that upside between what he paid and what the asset was actually worth once he changed how he used it. In fact, Warren Buffett ended up building Berkshire Hathaway on this exact same insight. Lesson number 10, know when to bet big. Teledyne, the conglomerate, was diversified across 130 businesses that they owned. They did this for safety. But Singleton's insurance portfolio was the complete opposite. It was heavily concentrated. He took personal control in the mid-1970s, and by 1981, he had shifted the portfolio construction from just 10% in stocks to over 77% in stocks by 1981. At one point, more than 70% of the portfolio sat in just 5 companies, and a quarter of that was in a single company. It was Listen Industries, his former employer, which he knew inside out. As a result of this concentrated portfolio, he was able to grow the portfolio value 800% over the course of the decade. Sadly, I've run out of fingers, but we are now on to lesson 11. Doing nothing is also a choice. Throughout the late 1970s, Teledyne generated a lot of cash, so investment bankers constantly pitched them deals. Analysts criticized Singleton for a lack of strategic vision. Despite that, Singleton ignored the pressure. He continued to pile up cash and buy back shares at depressed prices, instead of doing more acquisitions. The criticism got so bad that in 1982, Businessweek ran a critical cover story on Teledyne. The article argued that Singleton's refusal to make acquisitions was actually hurting the company and meant that it didn't have a strategic focus. And it also argued that competitors were pulling ahead. But just 10 weeks later, one of the greatest bull runs in American history happened, and so all those shares that he bought back at depressed prices now actually traded at double that. And the companies that they were pressuring him to buy at 15x were no longer worth it. It turned out that his strategy of doing nothing was the best strategy after all. Lesson number 12, stay alive long enough to get lucky. During his era of buying back shares, he faced an overwhelming amount of criticism. Every time he bought back shares, the stock price would falter and it would continue to go down. Any other CEO would have quit, but Singleton continued. And he was able to do this long enough such that he was proven right. Eventually, we know that he was proven right during the Great Bull Run between 1982 and 1990. But the only way that he was able to be proven right was because he stayed alive. And he did this by having little to no debt, ample cash, and a supportive board. Lesson number 13, no grand plans. Unlike most founders or public company CEOs, Henry Singleton didn't like multi-year plans. He said, "My only plan is to keep coming to work every day. I like to steer the boat each day rather than plan way ahead into the future." This flexibility allowed Singleton to take advantage of any situation that he found himself in. During the era where conglomerates had overvalued stock, Singleton was able to buy companies cheaply. And when the stock prices came down for conglomerates, he was able to buy back shares aggressively. Lesson number 14, what got you here won't get you there. By the mid-1980s, Teledyne's insurance operations, which were mentioned previously, had gotten big enough that they started to attract their own attention from analysts. But because these insurance companies were stuck inside this mixed conglomerate, they got little to no value accrued to them. The conglomerate structure that had helped in the 1960s was now holding Teledyne back. Singleton had spent 2 decades building Teledyne and its conglomerate structure, but he wasn't sentimental about it. When he realized that the insurance companies would be valued better by standing on their own 2 feet, he just spun them off. In 1986, he spun off Argonaut Insurance, and in 1990, he spun off Unitree. Once they had been spun off, these 2 insurance companies had more combined value than the whole value of Teledyne's conglomerate. The strategy that had originally built Teledyne wasn't the strategy that maximized its value, and Singleton recognized this and acted on this. Lesson number 15. Measure value per share, not size. During the buyback years, Teledyne shrank by most measures of success. Shares outstanding fell more than 90%. Revenue was declining. By typical CEO scorecards, Singleton looked like he was failing. But value per share was exploding. $1 invested in Teledyne dramatically beat $1 invested in other, faster-growing companies. For most executives, they're rewarded for bigger revenues, more employees, and faster growth. But Singleton, this confuses effort with result. For him, the only measure that mattered was value per share. Lesson number 16. Return capital when you can't use it well. By the late 1980s, the stock price had risen to levels where it wasn't an obvious bargain anymore. Most CEOs would look for new growth projects. Instead, Singleton started spinning off businesses and paying off cash dividends. He had no emotional attachment to Teledyne's size or his role in running it. Most people in this scenario would want to spend capital, but Singleton decided to return it back to shareholders. Lesson number 17. When everyone agrees, the edge is gone. In 1997, 2 years before his death, Singleton met with Leon Cooper, an investor and longtime shareholder of Teledyne stock. By then, share buybacks had become mainstream. Cooperman asked what Singleton thought. Singleton's answer? If everyone's doing them, there must be something wrong with them. His 1970 share buybacks created tremendous value, precisely because nobody else was doing them. Once a strategy becomes popular, the advantage disappears. Henry Singleton's record remains unmatched, not because he had unique access to information or opportunities, but because he thought and acted differently in ordinary situations. To prove that his formula wasn't genius or luck, and it's actually a blueprint that you can follow too, I've put together a breakdown of somebody who followed his exact strategy with remarkably similar results right here.